Hey guys, welcome. It's Ken McElroy with the Real Estate Strategies. I'm here with my friend Eric Freeman. Hey Eric.
Hey Ken, happy to be here.
So Eric's with Beach Fleshman, and they do all of our taxes. So it's a pretty big job. We're obviously a big client for them, but he does about 100 tax returns a year for us, and we're constantly on the phone, constantly emailing, constantly talking about anything and everything that we're doing at all times. So anything that we're doing basically on a sale or an acquisition or a disposition or a refinance or even capital work, we're running through Eric so that he can adequately tell us how to handle that this year, next year, maybe over a long period of time, to minimize minimize our tax, right?
That's right. A lot of moving pieces, a lot of pressure there.
Yeah. So anyway, it's great to have him here. And so there's all these questions that come in from you guys on various things through kenmcelroy.com that, you guys ask. And a lot of these are around ownership structure, which we've already talked about in one of the podcasts. And another one that always comes up, Eric, is, what's the difference between cash flow and taxable income? It's even actually confusing to me a little bit. You know what I mean? Because, I know there's some depreciation of some things in there, but I think a lot of people confuse, income, and then some of the things that they can offset it. So can you kind of walk us through that?
Yeah, exactly. That's a great question because people come to me with that all the time, not understanding what the difference between the two is. So the first thing when you're looking at an investment or a business or really anything is you want to figure out what your cash flow is. What's your cash in? What's your cash out? Is it profitable from that standpoint? The second piece is, okay, now that hopefully it's profitable or will be in the future, now what's your tax effect going to be on it? And there's a couple major items that cause differences. And it's specifically in terms of real estate. And the major one is one that you already brought up, which is what we call depreciation. So generally speaking, when you buy a piece of real estate, you're buying something that's going to be there for a long time, right? If you're buying a piece of land, it's not going anywhere. If you're buying a building, it's not going to just disappear next year, hopefully, right?
Yeah.
So you have to do what you call depreciate the asset. So you're going to basically spread out that deduction. So if you buy whatever it may be, say it's a duplex and you pay $500 for it, $500,000. You're not going to just deduct $500,000 on your taxes. You're going to have to spread that out however long the IRS says you have to.
What is that? Like, is it 27 and a half years?
27 and a half for residential type properties.
And you got to take the land out, right?
Yes, exactly.
So let's say land's $100,000 and you pay $500. That means that you can depreciate $400.
Exactly.
At 27 and a half years. So just 400 divided by 27 and a half, and that's your depreciation expense.
That's right.
Is that right?
That's exactly right. And nailed it. You want my job now?
No, I don't actually. Thanks.
So, and that's important to know because every year, the great thing about real estate and depreciation is in 27 and a half years, hopefully it's not worth less than $500,000. Hopefully it's worth more if you've taken good care of it and you've kept it updated and things like that. So you're actually taking a deduction for your tax return that's not a real economic loss. And that's the best kind of deduction.
Yeah. So think about this, guys. Hopefully your place cash flows, and you've been listening to some of these podcasts. Cash flow's king. So hopefully you have, let's say you have $3,000 or $4,000 a month in cash flow. Depreciation expense might wipe that out.
Yeah.
You literally have your cash flow, which is income, and then your depreciation, which is a non-operating expense, and you actually can report a loss.
Yeah.
Right? So you get cash flow tax-free, and you get to report a loss on your real estate. So that's what we're talking about here.
Yeah, it's a beautiful thing.
It is.
And you can do that in some other businesses, but not necessarily to the extent as real estate because it's such a capital intensive type industry. And it's something that, when you buy a car and depreciate it for a business, there's an actual loss going on there. It may not be the same as your deduction. It may be worth something at the end of 5 years. But the real estate is something where, there's not a true economic loss there, which makes it a great benefit.
Right. In a lot of cases, if you take care of it, it can go up. Right. The other thing that, is a sneaky little thing inside of here is the cost seg, cost segregation. Can we talk about that? Because we talked about 27 and a half years. And I think on office, it's 31 years. Is that
39.
right? 39
Yeah,
years.
You're stuck in the 80s, Ken.
I am sorry. The last time I looked at the tax code. So 39 years. So essentially same thing. If you pay 500 and the land's 100 and you got 400 in basis, is that what it's called? Or in
Right,
then,
cost basis.
then
yeah.
you can divide that by 39 years, and that's your number if it's a commercial building. But cost segregations are something that you guys do for us. Right. Super cool, guys. If you're not doing this, you should be doing this. It's like component depreciation.
Right, exactly.
So let's walk through that, because this is something that a lot of people miss. And this is to me, low-hanging fruit and something that you own already if you're not doing it. In fact, I had one of my subscribers emailed me and said, just that saved me thousands of dollars. Just that one tip saved me thousands of dollars a year. So can you walk through how that works?
Yeah, exactly. So generally speaking, when you buy real estate, you've got this long depreciation schedule. But if you walk inside the building, you look at the parking lot, various components of it, then a lot of those items aren't actually going to last 27 and a half years. So sure, the structure will be around. Hopefully the roof, if you maintain it, will be around. But the carpeting that you walk on, some of the ancillary lighting,
the floor, the refrigerators, the stoves,
right, appliances, movable things, they're going to break.
Yeah, things that break in 3, 4, 5 years, right? All those things are basically different.
Right, yeah, they're treated different. But if you can't just walk into a property, say, let's use the duplex example again, buy it for $500 and then say, well, I spent probably the refrigerator's worth $500, the carpet's probably $1,000, whatever it is. You can't just put a dollar amount on it. You have to do what's called this cost segregation study, which means that someone goes in, usually an engineer, and they break down the different components into what essentially, in simplistic terms, isn't going to last 27 and a half or 39 years. And they give you a breakdown and they say, this is what we call personal property, different from the real property. Basically, it's movable. So you're talking about, again, the carpets, certain lighting, some fixtures, maybe some of the light switches, just all these little things that won't last, that are going to get replaced. And they say, this is the dollar amount of what you paid that relates to these type of items. And nowadays, so in the past, you would have to depreciate a lot of those items over 5 years generally, so much shorter. But recently we got a new benefit, and it's called bonus depreciation, which basically means
this is important.
Just take it all now. If it's 5-year property,
this is very important,
expense
guys.
it.
Bonus depreciation is a big deal.
Right. Yeah.
So essentially, anything. I mean, think about this: when you buy a duplex, and we're talking about this duplex, everything that you're looking at, inside and out, has a different useful life. Period. Some might be 1 year, some might be 2, 3, 4, 5, some might be 10. Like the framing and the drywall and the roof are going to have long useful lives. But the appliances, the flooring, lots of little things inside of there are not. And so we're just taking all that, right, and sticking it into a cost segregation study and doing this bonus depreciation, which really, really bumps down that taxable income.
Yeah.
Right.
It's great if you have income from another source. Maybe you had another property you sold. You can help, offset that income. Maybe depending on your tax situation, you could have maybe offset some of your other, maybe if you have W-2 wages, depending on where you lie and how you're treated under the tax code. But it can help reduce your taxes elsewhere.
So let me walk through this, guys. All right. So we just said that you got, let's say, $400,000 in base cost basis, and you divide that by 27 and a half years, and you got, let's say, $3,000 a month of income. You're going to have a tax loss. Now, if Eric finds through a cost seg that we can have another $1,000 a month of tax loss, let's say, another $12,000, then all of a sudden your tax loss gets bigger. And so you're reporting, let's say, a couple $1,000s of loss per month to the on your partnership, right? So call it $20,000, $25,000 a year. you can now use that against something else, right? So this is what you kind of alluded to, but I want to really make this clear. As you start to stack up real estate in different partnerships, you start to buy and sell and do all these different things, you can use tax losses from one for another, right?
Generally speaking, so this is one of those times, Ken jokes about me using the words depends all the time. So I'm gonna use it here. It depends. So this is one of those situations where you want to talk to your tax advisor first, make sure that you're fitting the requirements to be able to do that. But generally speaking, if you're active in the property, and depending how much that loss is, you can offset some of your other taxable income. So, I mean, it's just a freebie deduction. It helps, and every tax dollar saved is more income.
Right. So one of the secrets that you guys may not know is when we go down and meet with Eric every single quarter, we're actually managing what we call our NOLs, our net operating losses, right? Mm-hmm. So he has a number of what that is. So for all of our real estate and all of our businesses, we know what our NOL is. And so we're constantly trying to figure out how to use that, right?
Right.
To offset income somewhere else, all legal.
Right. Yeah.
So I'm telling you guys, as you start to stack up multiple businesses and multiple real estate in these different partnerships, these things can work with each other if you're active.
Yeah.
Right?
Yeah, and that's a great point, is you can't look at each either investment or business in a vacuum if you got multiple going on, because if you are going to generate losses in all of them in one year, well, that may not help as much as it may be to generate income in one this year and use a loss from somewhere else to help offset it. That way, you can generate a loss in that other business the next year, depending on how things work out. So it's a lot of timing and planning that makes a big difference.
But you guys can do that. So, there's what's happened with Eric is, he always asks, what's the plan on this asset, And sometimes we decide to renovate and upgrade things, in a current tax year because we're getting all the bonus depreciation losses, on a renovating units. And all of a sudden, when we do that, we're getting $150 to $200 more per month. So by spending money on the interiors, we can take the bonus depreciation and run it through this year, but we also get the increase in the NOI for the higher rent. Right. And so these are some of the things that you guys need to do and should be doing as you're working with your tax accountant that you will not get from your attorney. So you really have to be cognizant of some of the moves that you're making. And so what happens a lot of times is people just sell things and they buy things and they do things and they don't know why. Right.
Right.
Yeah. And then the accountant's trying to figure out how to, put it together. What we do is we go to Eric first. So when we just did that big 4-property, like 1,000 unit conversion, I'll call it, we went to you first before we even went to the partnerships. Yeah. We went to Eric and said, what's the best thing we can do here, to benefit the partnerships from a tax standpoint. And then we went down that direction as opposed to just moving forward.
Yeah.
And raising capital and doing it, right?
That's a great point. This reminds me of a situation that just happened. A new client came to me, and he's mostly doing flips. And he had a property that he bought in November or something, and then he ended up selling it a few days before year end. And I looked at it and I was like, well, there's a good chance you probably could have delayed the closing into the next tax year, and then you would have been able to wait another 365 days to actually pay the tax on it.
Right.
Which helps.
It helps a lot. These are things that you guys need to be cognizant of. In fact, on that deal, we bumped it into 2020.
Right. Yeah.
Intentionally. We could have closed in 2019, but it made more sense for the partnership to move the transaction into the next year because of tax and things that we could do. Because then if we do that, but then you start to renovate and you can start to take that bonus depreciation in 2020 to offset the tax.
Right, exactly.
Right?
Yeah.
And otherwise we would have paid tax in 2019 and still done that, but we would have already paid the tax, right?
Yeah, that's exactly right. It's definitely, you have to pay attention to the timing, and that's why it goes all the way back to depends. It depends what's going on.
It always depends. Hey, so we talked. There's common expenses: real estate taxes, federal, state income taxes, insurance, mortgage interest, repairs, management fees, cleaning, utilities. Let's talk about mortgage principal. How's that? That's like one of those big things that people are confused about. How does that work from a tax standpoint?
Well, that's a great question. So when you're looking at your cash flow,
Depends, right?
maybe not in this situation, almost. So generally speaking, you're going to look at your expenses and you're going to see your mortgage outflow, and that's comprised of both interest and principal pay down. And when you're adding up your net cash flow at the end of the year, sure, both of those items, the interest and the principal, are going to reduce your cash that you have at the end of the year. But for tax purposes and just thinking about what's actually happening when you pay down the loan, it's not a real expense, the principal piece of it, because at the end of the day, you're really just trading your asset, which is cash, to reduce a liability, so you owe less. So what's the net of that? It's still zero. You haven't really changed where you're at.
I see.
So that's why for tax purposes, it's not an actual deduction, the principal piece, because it's not an outflow, but the interest portion is. So what that means is that's an item where it reduces your cash flow, but it does not reduce your taxes. Your taxable income, if you just look at that piece, will be a little higher, and that's where you want to look at other types of tax strategies to help offset that difference.
So let me tell you guys what we just did. We just did a 2.75 fixed rate loan, which I was telling you about before the show. 10 years IO, or interest only.
Yeah.
Okay, so think about what he just said. So we get to deduct that interest, right? We're not paying down principal, so we have more cash flow. Right? So we have no principal payment. We have interest only for 10 years at 2.75. So we get to write off all of that 2.75.
Right. That's exactly
all
right.
the interest, because we don't really get a benefit from the principal.
Right.
Right?
Other than reducing debt, but at the end of the day, as low as interest rates are, I'm not sure you want to do that.
And hopefully with this coronavirus, we'll see inflation, and the debt will be reduced anyway. Right?
One can hope, right?
Yeah, well, we'll see. But okay, and then so let's just talk in general here. What can somebody that's just beginning do from a tax standpoint here? You know what I mean? What are some of the best things that they could do when they buy?
Well, other than getting a good tax advisor, more specifically, there's what we call a 20% pass-through deduction, which basically means that if you are in a trader business, so if your rental properties qualify as a trader business, then you can get this freebie deduction. So it's 20%. Whatever your net taxable income is, just take 20% of that and write it off. So that's a nice reduction in your taxes. Now you have to, in order to meet that, you need to be active in the property. You can't buy a property and then have maybe the tenant schedule the repairs and things like that, and you can't really rent to family, things like that.
So
there really aren't.
This is a gray area. This active. What is considered active? So because this 20% pass through is a big deal for you guys. So what does that mean? How can we be crystal clear on what active is?
Okay. So basically you want to be making the day-to-day decisions, and you want to be involved in the activities that are happening. So
can you have a property manager?
You can have a property manager, but you still need to have ultimate decision-making power. So if you just turn it over to them and you say, I don't want to see any of the applications. I don't want to know who you're renting to. I don't want to know what's going on at all. You're going to be less likely to qualify for it versus if you hand it over to them and you say, yeah, go look for the tenants, show the place. When you've got someone that you think is a good fit, let me know. I'll look also, give you the final approval. And then you want to make sure that the management company, you can use an agent to do work on your behalf, but you want to make sure they're actually the ones scheduling the repairs and things like that, because really that's a lot of the the things that happen throughout the year is scheduling repairs. So when the tenant calls, the management company hopefully is actually scheduling it and not telling them, oh, okay, just go get a bid and you take care of it and we'll reimburse you. That won't work, because then you're not actually active in doing it. Now all of a sudden you've transferred that responsibility over to the tenant.
Right. That's a really good point. Yeah, a lot of people do that all the time. I actually don't advocate that at all, because I've seen tenants that, have painted walls black, and they bought small water heaters, and there's all kinds. They put funky flooring in, and all this kinds of things that you allow and do, and when they move out, you're like, oh, bad decision, right?
Yeah.
Right?
Yeah.
You have to actively manage that physical plant, you guys, and you should, like Eric said, if you are going to use a third-party manager, which apparently you can still do, then you need to manage them, which is going to be good for you guys anyway, because the real estate is a business, and it's not like a stock. It's not something that you could just buy and walk away from. And more importantly, you want to be able to qualify for this 20% pass-through deduction, right?
Yeah, I mean, it's easy enough to do it that way, and it's good for your business.
Yeah,
so.
Awesome. Great, Eric. Thanks again. You're the best. I appreciate it.
Thank you.